And we're live. So, welcome everyone back to the third Money Masters Twitter space. I'm Dave, and I'm here with.
This is Noah.
And today we're just going to be talking about a very interesting topic that is really making its waves through the news. So, before we do that, we just want to kind of take you guys through a brief introduction about Money Masters and kind of some of our recent Twitter spaces that we've done over the past couple of weeks. So, first, I'm Dave. I'm a project manager here at Money Masters, and I kind of do a little bit of everything here. I work on our marketing, working on sales, working a little bit of content, and now I'll pass it off to my co-host.
Thank you, David. So this is Noah again. I work here for Money Masters, working on the content development. And if you don't know what that was on, that's with our Academy. If you haven't tried it, please do so. The Money Master Academy is a great tool. Learning how to work on both personal finance, investing, trading, and we really believe that anyone, whether you have a CFA or don't know anything about finance, you are able to get something out of that. Thank you, Dave.
And so that's our academy, but there is another big portion to the Money Masters app. So one of the big analogies that we use here at Money Masters is we're actually running a marathon next week, so this is very fitting. If you want to run a marathon, you're going to put your mind to it, but the first thing you're going to do isn't just pick up your running shoes and go join the one that's closest to you. What you're going to do is you're going to practice and you're going to train. And this was our idea behind the Money Masters Arena. Within the Money Masters Arena, you can practice investing in a fantasy stock market for either a day, week, or month-long tournament. We believe this is a great alternative to actually just going out and putting your money within the stock market, because if you don't have any sort of practice and you're not familiar with it, it could be a very dangerous place. So when you go into the Money Masters Arena, you can enter either a daily, weekly, or monthly tournament so you can practice investing risk-free. And what you do is you actually enter into a competition with a bunch of other people who are all there for the same goal, to practice investing. And if you finish within the top 3 in either a daily, weekly, or monthly tournament, and even if you finish in 4th through 15th, you have the opportunity to win vouchers from some of your favorite brands. And with that, we're going to kind of trail back to what our last week's episode was about. So last week we talked about inflation, predominantly that in the United States, which is reaching highs. Currently, it's around 8%, and we kind of outlined the 3 main reasons for this. The first was the COVID-19 pandemic. So within the COVID-19 pandemic, it was unprecedented, and we saw supply chains around the world slow down. Second is overseas issues, such as that seen in Russia and Ukraine. This clearly has affected prices in commodities such as oil and gas. And finally, when we're referring strictly to the United States, we can see that 50% of all currency that is currently in circulation was printed within the past 2 years, all leading to significant inflation levels. And that leads us right into this week's topic. With inflation, the government and Federal Reserve need to come in. And the government and Federal Reserve are coming in a huge way with the interest rates. So, Noah, you want to kind of talk us through a little bit of the history about interest rates?
Yes, I do. And I want to talk about that by asking you some questions about interest rates.
Perfect.
All right, so here we go. So, the first national debt, or first government national bank, issued debt in 1798. Would you like to take a guess of what the first interest rate offered was?
It's a tough question. I'm going to guess back then it was around 5%.
Ooh, just a little low. 8.1%.
Wow.
Yeah, a little higher then. So since then, we've had a lot of fluctuation in interest rates. So do you want to take a guess as to when and what was the highest recorded interest rate offered?
So I remember that it was in 1980 because there was a lot of stagflation going on at the time. Mm-hmm. But the exact rate I'm going to guess was between 20 and 25%.
Ooh, okay, so your time is right on the money. In September of 1981, the highest interest rate recorded was 15.8%. But you're right, that was a time of really high inflation, stagflation actually at the time, and interest rates across all kind of assets were going to be really high. Now, can you do the reverse? When and what was the lowest interest rate?
So there are 2 things that my mind immediately goes to. Obviously, COVID, because it was recent.
Yep.
And you can't forget about the 2008 recession.
Oh, no.
So I'm going to say that interest rates at one of those two times had to be at around 1%.
Okay, well, you're really on the nose there, really, really, really close. In August of 2020, so yes, in response to COVID, interest rates hit 0.5%. So yes, they hit really quite low. Now, we're talking about interest rates, but you might have heard a lot of different rates or a lot of terms that are thrown out there and not exactly sure which is which. So first off, we use either a 10-year treasury yield, which is the debt exactly that comes out of the government you can buy yourself today. We also use the federal funds effective rate, which is how the Federal Reserve will lend to other banks. So, David, what is your guess right now at the 10-year treasury bond rate right now?
I'm not a big bond guy, so I'm not too sure about this one, but I'll guess somewhere 3%.
Oh, yeah, you're right on the money with that. 3.05% at the time of this recording.
Amazing.
But can you do the same thing for the federal effective rate?
I'm not. I know that it went up a little bit with the last quarter, and it went up by like 0.25 or 25 basis points, if I'm not mistaken. And this was probably around 1.5%.
Little high there. Currently at this time, 0.83% is the effective rate.
Okay. Awesome. So, if you're listening right now, you're probably wondering why governments would actually do something about their interest rates. So, in particular, when you're looking at the United States itself, the U.S. tries to separate money and its government in as many ways as possible. And what they did was they actually created the Federal Reserve. And what the Federal Reserve's job is to promote maximum employment and for prices to be kept stable. Obviously, if you're available or listening in from the U.S. right now, you would probably know a little bit about how the U.S. is battling inflation problems like never seen before. Some goods that you used to look at in the grocery stores that were $1 might be all the way up to $1.10. And this goes for almost everything. So when we're talking about the interest rate that you hear about in the news so much, this is one of the most effective ways of monetary policy that we've seen studied in government's cases and countries' cases as a whole. So the Fed fund rate, which for some of us who are just in North America or Canadian listeners as well, is known as the overnight rate. And this is the rate at which banks borrow and lend to one another. So just like how we take out loans, banks do this as well. And it is a little bit of a different reason as to why. So banks have laws that govern them. And one of the big things about it is something called the reserve requirement. So for us, whenever you're speaking about the reserve requirement, the biggest thing is that governments will usually impose a percentage on how much they need to keep in their vault at all time. For us, right now, it's currently at 10%. And the easiest way to describe this is with a little example that some of my professors in university used to teach me was, if you go into a bank and give $100 to them, say put it in my savings account, not all $100 will actually just be kept in the back in the vault. Otherwise, they'd have millions and millions of dollars just sitting there. So what they end up doing is they're like, okay, the government said that we need to keep 10% of this. So from that $100, $10 will be kept in the vault, and the other 90 will be given out in forms of loans at the interest rate that's given to other customers. Usually it goes up because the interest rate is seen as risk-free. So in this case, it's very safe to borrow from other banks. And with that, we're going to kind of go into why they actually decreased interest rates back in 2020. And in particular, just in general, why interest rates would decrease. So, Noah, you want to take us away with that?
Yeah, happy to. Thanks, Dave. So, yeah, one of the reasons why interest rates will fall, as you said before, is we use these Federal Reserve rates as kind of what we call our risk-free rate in the kind of terminology. But it really means that, Dave, I'm sure you're a very trusting guy, but according to investors, you are not as trustworthy as the federal government, or at least the U.S. government. So we use this as the benchmark of everything above that has a little more risk on top of it. So actually, let's go back to 2008 when the Fed dropped rates from 5.1 to 2.3%. And that really means that the baseline of everything else goes along kind of with it. So when we, for example, whether it's a bank borrowing from another bank to do whatever project, but let's say you yourself want to have a mortgage, it takes less money for that bank to offer it to you, because if the minimum rate for the Fed is a little higher, it's more for you. If it's a little less, it's less for you. So across the board, it kind of works in tandem. But now the government really wants to make sure that you are not keeping your money around. So if it's cheaper for you to make a large loan, whether that's personal or a mortgage, you're more inclined to do it when rates are lower. But it also gives an indication that a government, if they're keeping rates low, means that they're fairly confident with inflation, which we just recently talked about.
So, because you heard about the rates being lowered, I'll kind of take it away with a little bit about why the interest rates would increase. Why would the government do this? Well, the big thing is that when there's an interest rate increase, demand for money falls because now it's more expensive. So what a lot of people are going to do in this time is they're going to hold it. They're going to keep it in their bank account, which is increasing their interest rates as well. So this has an effect on the economy holistically. So the biggest thing we see this in is obviously the stock market and obviously with price stability. So within your personal life, one thing that they do is they're going to increase the interest rate because they want to keep prices stable. The Federal Reserve, its main goal is to keep prices stable and for maximum employment. So in order to keep prices stable, they need to kind of cool the economy a bit. The economy has reached new heights never before seen. And now it's slowly starting to get brought back a little bit to reality. Not a bubble has burst, but in fact the market has just slowed a little bit. So when people are looking at the interest rates, and what they're seeing is they're seeing that they can get, what did you say the interest rate was right now, Noah?
The effective rate right now between banks is 0.83%.
0.83%. When you're looking at this, you're going to say, okay, the stock market is currently down from the beginning of the year. So what a lot of people are going to say is, oh, I could actually just make some money if I just keep my money within the bank. And they look at this as the risk-free rate. They'll also invest in bonds and do stuff like this so that the U.S. GDP as a whole will expand. So instead of taking on some riskier type of investments, what they're going to do is look at this risk-free rate and see, okay, can I make above this amount of money? And if they say no, they're just going to keep it, which is what a lot of people are thinking in their heads right now. Now, obviously, the economy cools, and you're going to see not as much growth in big sectors such as technology or consumer staples or consumer discretionary. But this is very good because it does bring everything back to its baseline and what everything is going to be properly valued at. So when you have this benchmark, it's also very good for people like us who don't really think that everyone should be able to get a loan at rates that are very low. Obviously, we saw this back in 2008 when the rate was close to zero. Even before this, it was close to zero. So it's going to encourage people to not take on some of these riskier loans if you're in a bank. And this will help it improve the economy in its own way because it's cooling the inflation that was already going on. And now, because we're actually located in Switzerland right now, I think we actually want to talk a little bit about what would happen if the interest rate went negative. So, Noah, you want to speak a little bit about that?
Yeah, so maybe over the last 10 years, you probably heard about that European interest rates were negative, and that's quite true. Now, since then, interest rates across the world are always rising right now. So if we see with the Swiss market right now, the 10-year debt for them is about 0.9%. But as we keep alluding to the their interbank system, their SARON, which actually stands for the Swiss average rate overnight, is currently at negative 0.71, which is really surprising, as essentially that's like you giving that $100 to your bank, and then you have to give them a quarter to keep it in the bank. Mm-hmm. You have to pay them to store it for you, and that's kind of the idea behind these negative interest rates. And again, it incentivizes that you really shouldn't be keeping your money in storage, but that it should be out doing something, or that you should be borrowing money or putting it into investments and trying to get it out the door, which seems to be the opposite of what governments are trying to signal, maybe the real bit of the reverse these days.
Mm-hmm. And that's actually big because if you actually look at Swiss inflation rates right now, Switzerland, obviously a very stable country that has always practiced neutrality, they aren't exposed to a lot of these political risks that some other countries would be, obviously. But their inflation rate year over year has actually been very stable. And right now it's at a high, and it's at 2.4%. Now when you look back at the US, where it's currently at 8%, this is a drastic difference between the two. And with that, I believe we're out of time for the day. And we are going to conclude today's Twitter space. So, from David and Noah, we would just like to say thank you guys very much for listening, and we're looking forward to having you guys on next week, where we're actually going to be talking about
government debt.
Everyone's favorite topic, currently making headlines all over the world. Thank you guys for tuning in, and we'll see you next week.
Thanks, everybody.